What is up, everybody? AKA Spencer Dunbar here, and we're coming at you with a new video on two of my favorite dividend stocks. These are stocks that I am putting in my Roth IRA for the long term and that I really like. So I'm going to try and give you a quick rundown on the DD that I've done on these stocks, why I like them based off of their financials as well as their charts. And so we'll just jump right into it with our first one. This is ARCC, Ares Capital Corporation. So I'm going to talk about their dividend, but I'm going to do that last because we'll go to the dividends and earnings tab here. This is Fidelity for those that don't know what brokerage they want to use or haven't used one yet. I love Fidelity. I've been using it my entire time. It's the first brokerage account that I started, and they don't put a bunch of stops on your stocks like Robinhood has done. So, but jumping right into it, both these Roth IRA stocks that I like are BDCs, Business Development Corporations, and what that means is that they help new and financially distressed companies grow their revenue. That can be from loaning them money on top of other things as well, which basically ends up appreciating that company in value and in turn getting more value for ARCC and ORCC, these BDCs that I'm talking about. So you have to have a lot of faith in the management of these companies. It's very important for them to decide profitable companies that they can help and that will do well in order for them to make their money back. But we're going to jump right into this. I have quite a bit of information for these two. We don't want to take too long. So ARCC, looking at this, we can see all the information we need right here. We have a 52-week range, low of 17 and a high of 23. When you're looking at this kind of dividend stock, it's important to have two things. You want a good dividend yield. For me, a good dividend yield is 4% and above. I usually aim for that 6, maybe 7% range. If you can find something a little below that but still has really good fundamentals, and even above that but still again has good fundamentals, then you're all set. But what you're not going to see with most of these ones that have higher dividend yields, like 7+ dividend yields, they're not going to have an insane amount of price appreciation because a lot of that money is going to the dividend holder, not necessarily back into the company itself. Or they're kind of set in a way where the stock price isn't going to vary a lot. There's not a lot of things happening within the company news-wise that's going to run the price up or drop it down. They tend to follow the market a little bit, but usually a little bit softer. So I do like these kinds of investments for the long term, and I think that they can be a lot more profitable, especially if you're looking for more hands-off investing types, which I've been getting into, more passive income, more dividend income. So jumping back into it, it has a $10 billion market cap. I like to see that. I like larger market caps for these kind of stocks that are paying out a dividend because not only is it more money for them to work with overall, but it kind of shows that this company is not a small fluke. I don't like dividend paying penny stocks because the company can go under in an instant and then all the dividend earnings, none of that matters anymore. So I do like these larger market cap dividend stocks. PE ratio of 8.8, which is pretty good. I like my PE ratios for these kind of investments, my longer term ones, to be between 5 and 10, maybe up to 15 if it has a really good financial background, but that's a good PE ratio. This kind of shows that it's not necessarily in a phase of growth. Usually growth stocks that are still up and coming have a PE ratio of like 20 to 30 and even a little bit higher than that because they haven't just adjusted that PE ratio to what they're earning yet. And so overall, it'll come back down as those stocks progress, but that kind of just shows you that this stock, again, isn't fluctuating a lot. They've done a lot of their growing, and they're just being consistent with what they're putting out. So I do like that a lot. Yahoo has this stock ranked as undervalued on theirs with, they say that it has speculatory growth in the short term, midterm, and long term. I don't love following these analyst price targets because they can be super wrong, and then you're the one that loses money. So, but it's nice to have a little bit of backup and see their reasoning why. We talked about their PE ratio, so we'll go ahead and jump right into their chart here. I'm going to go to their max chart first, and one really important thing that I've learned with these kind of stocks is you want to look at the max chart. Now, the opening price and the current price don't have to, the current price doesn't have to be above the opening price, in my opinion. You can have a really good opening year and then a dip like we see here. So this was IPO'd, and it had about 4 or 5 solid years, and then we hit that nasty crash 2007, 2008, all the way into 2009, and then we saw a nice run up. So from here, I do think this shows a lot of growth, and that's a period that you're not really going to get in the market often, but it is nice. After that, you see from 2010 all the way until 2020, it had 10 years of just consistent rising and falling, nothing too crazy. It literally, I think the most it went was from 15 to like 19 in that period. So a $4 swing, nothing crazy, and you're still getting those nice dividend payouts. COVID hit and it did drop, and then since then has rocketed back up. So I do think this stock long term shows a lot of potential, not only from their dividend, but I think we could have a bounce back and push to some new all-time highs just as the market recoups. Although we are in a recession now, if the government wants to admit it or not, we are in a recession. 2 quarters of negative GDP growth, that is a recession. So we'll see what this thing does. The market has been doing really well off that news because typically by the time you hit the recession, a lot of people are ready to buy back in because we're so delayed on everything. But we're going to go ahead and jump right into their earnings and dividends. So this is all, again, it's on Fidelity. I like using this. They have really good detailed dividends on here. So we can see it started at 40 cents. That was all the way back in Q1 of 2020. And now we're trading at 43. Not trading at, they're delivering 43 cents per share on the dividend. So looking at the dividend details, this is where it's really important with these kind of stocks. You want to see how they've been doing in their dividend. Have they decreased their dividend recently? And we're going to go all the way to the bottom. So 2012 is when they started paying out that nice dividend, and they had special dividends. So regular dividends are what they pay out quarterly, and special dividends are what they pay out on top of the regular dividends, depending on how the quarter did. If they have an insane quarter, they'll give out a special dividend that goes right to the dividend holders, right to the stockholders. And if they don't, then they don't pay out that dividend, but you still get that nice starting with 38 cents per share. And we've since then worked our way up. It was at 38 for a long time. We just got into the 40s in 2019, and now we're already up to 43. So that's a really good amount of growth. If you realize that it stayed at 38 cents all the way until 2018. So it had 8 years of being at the same payout dividend amount. And then from there, we went from 39 up to 43 in just the last 4 years, a little more than 4 years. So that's showing a lot of good growth with this company, and I do like to see that, as well as like I said with their long-term chart. So their special dividends are nice. They pay those out pretty regularly. Of course, we had that spat with COVID where everything was down. They did not pay out those special dividends. So typically when the market's going down, they don't pay those out, and when they're doing really well, they'll pay them out, and it's just kind of a bonus. So that's kind of the first of the two stocks that I really like, and we're actually going to go ahead and we'll jump right into the next one, and this is ORCC, similar ticker, Owl Rock Capital Corp. Now this one is a bit riskier just because it hasn't been around that long, and we're going to go right into the chart with this one. We'll go into the max chart. You can see that it only has been around since 2019, and that's more speculative, of course, because it's not as much of a dividend payout history that we can look at. There's not as much information as a company like Ares Capital that's been doing this for 15, 20 years. But I still think this one has a lot of progress. If you think about it, if you had gotten into Ares Capital Corp when it was only 3-4 years in, you would have made a nice profit. And it's speculative, and this isn't financial advice for anybody, but I think ORCC has the leadership to do just what ARCC did. So not as much of a chart to look at, but you can see that it is beat down pretty heavily, and that of course comes from when we see fluctuations in the market like we have been, when we see things dropping really heavily and we see things heading towards the recession. ARCC is the company that's going to do better because people want to see that 20-year history that it has, and so that gives a lot more promise and a lot more trust in the leadership of that company than a newer speculative one like ORCC, even though it does pay out really nicely and they are relatively proven through their management. But again, people are going to pull out of this stock before they do ARCC because it is more speculative and there is more risk, but that makes it all the more better buying opportunity. And so we can see on the 52-week range, so the 1 year range from lows of 12 to highs of 15, not that much swing. But if you did jump back to that $15 mark from here, that would be a pretty good percentage gain for a stock that pays this portion of a dividend. PE ratio of 9.9, just under 10. We'd like to see it. Average volume doesn't matter as much with these because you're not really going to swing these, in my opinion. Typically you wouldn't. You would be a lot less profitable than swinging other larger cap companies, and especially some smaller cap ones. Market cap $5 billion. Again, this is a little bit low, but that's what happens when you have a newer stock like this one. And then short interest and all of that, which isn't as important to me on these Roth IRA longer term stocks. So we're going to jump into the dividends and earnings. ORCC, a nice 9.62% dividend, which is absolutely crazy. Absolutely crazy. 3 times the market median. And I actually didn't mention, but this one does have a price target from analysts, from CNN Money, of 16. So a nice $3 return from this point, $3.10 if it gets to that point. Again, but I don't like to listen to those guys specifically just because they don't have any skin in the game. So ORCC, their dividend is going to look different because, again, they're not as old. So since 2019. So they started with a regular dividend of 44 cents, and they did decrease that. Typically, you don't like to see decreases. This is really early on in the company, so it's not as important. If it had had 20 years of consistency and then a decrease, that would be really negative. But we're seeing here that they went from 44 cents to 31 cents, and since then they've been paying 31 cents as their annual dividend amount. So relatively consistent from that one drop, and of course it was the drop right after, so they probably realized, hey, that's too high of a dividend, we'll drop it down to this, and we'll continue to pay that out, which is good. It's good to see that they are adapting. They have not had a special dividend in a while, of course, because they have been dropping with the market with this recession. But that special dividend payout of 8 cents per share is pretty nice. That's higher than ARCC, and that shows that they were profitable during this period. And I think they'll go back to a period of profitability really quickly, especially if the market bounces back. So that dividend's really nice. I think that both of these stocks have a lot of potential. I think ORCC is higher risk but higher reward overall. I don't really have many negatives to say about this company other than it's just a little speculative that they haven't been around that long. But when you see the special dividend, when you see a lot of the price targets for these kind of companies, and you see the management behind these companies, that's really important. Go to the websites if you're going to do some DD. Go to the websites, look at these companies, and see what you think about the website. Does it look professional? Do you like the management team? Do they have a good history of business and running these kind of companies and making the right decisions with these companies? Because again, that's really important. So these are two of my favorite ones. I'm going to put, these are already on the TikTok. I'm going to do a post of these on my blog. I have a free finance blog at akspenserdunbar.com. Be sure to go check this out. And if you got any bonus from this video, if you got any value from it, that's the word I'm looking for, please go ahead and like, subscribe, and comment what you think about these. And if you have any other stocks that you want me to look at, that from all sorts. I love penny stocks, I love swing trading, and I love these long-term investments, and I do love big market cap stocks, big blue chip companies. But please, go to the socials, check those out. Hopefully that they provide some value, and it's fun to create a little bit of a community with this kind of trading. And hopefully everyone had a good Monday today. My stocks didn't do great, nothing crazy, but we'll see what happens with the rest of the week. And again, thank you guys for watching, and go check everything out.